Welcome back to the channel, Gate Gain, where we explore smart, modern strategies to build long-term wealth. Today, we are diving deep into the world of commercial real estate crowdfunding, a powerful investment vehicle. This method is completely transforming how everyday people build property portfolios without needing millions in the bank. For generations, multi-million-dollar shopping centers, office complexes, and massive apartment buildings were reserved exclusively for ultra-wealthy institutions. Historically, only accredited individuals or massive hedge funds could access these high-yield institutional assets. Today, online platforms allow everyday retail investors to pool their capital together to buy fractional shares of high-yield properties. These platforms enable participation with surprisingly small starting amounts, making real estate ownership accessible to everyone. In this comprehensive tutorial, we will analyze how these digital platforms operate and how you can evaluate potential deals. We'll also look at how to maximize your overall returns safely while building a diversified portfolio. To truly understand commercial real estate crowdfunding, you must first recognize the shift away from traditional property ownership. In a standard transaction, an individual must secure massive bank loans and provide huge down payments. They must also manage physical land, tenants, and maintenance directly, which can be an operational headache. Fractional ownership completely removes those operational headaches while still giving you direct financial exposure to lucrative assets. Crowdfunding platforms act as legal and technological intermediaries, aggregating funds from thousands of individual contributors. By breaking down ownership into affordable shares, these platforms make high-yield property investment accessible to almost anyone. The fundamental legal framework that makes this industry possible stems from modern updates in securities regulations. Laws like the Jumpstart Our Business Startups Act fundamentally changed how companies raise capital from the public online. Before these regulations, private real estate offerings could not be publicly advertised to retail investors on digital channels. Now, accredited and non-accredited individuals alike can browse vetted commercial offerings directly on user-friendly web portals. Understanding this legal backing gives you confidence, knowing that reputable platforms operate under strict regulatory oversight. This ensures complete financial transparency and protects your contributions as you build your personal wealth over time. When analyzing commercial real estate crowdfunding, you will quickly notice that investments fall into two main categories: equity deals and debt deals. Equity investments mean you are buying an actual ownership stake in the physical property alongside other members of the pool. As an equity holder, you profit from regular rental income distributions as well as long-term property appreciation when the asset is eventually sold. While equity investments generally carry slightly higher risks, they also offer the highest potential upside and valuable tax benefits. Understanding whether an equity structure aligns with your personal investment timeline is a crucial first step towards selecting the right opportunities. On the other hand, debt investments operate much like acting as a digital private lender to a real estate developer. When you participate in a debt crowdfunding deal, your funds are pooled to provide a loan secured by the commercial property itself. In return, the developer pays fixed interest rates over a predetermined term, giving you consistent and predictable cash flow distributions. Debt investments sit higher in the capital stack, meaning debt investors are paid back before equity holders receive profits, offering a safer cushion. However, debt investments do not share in property appreciation, meaning your upside potential is capped strictly at the agreed-upon interest rate. Now let us examine the core mechanics of how online platforms structure these fractional deals behind the scenes. Usually, a platform or real estate sponsor creates a special purpose vehicle, such as a limited liability company, for each individual property asset. When you invest your money through the website, you are purchasing shares or membership units in that specific company. That entity then purchases the commercial office building, industrial warehouse, or retail space directly. This legal structure protects your personal assets outside of the investment, limiting your financial risk solely to the capital you choose to commit. One major advantage of commercial real estate crowdfunding is the ability to achieve immediate portfolio diversification. Instead of committing hundreds of thousands of dollars to buy a single residential home, you can spread smaller amounts across multiple property types. For instance, you can allocate portions to a medical office in Texas, a multifamily apartment building in Florida, and a logistics center in Ohio. Spreading your capital across diverse regions and asset classes significantly lowers your overall portfolio risk. If one local economy slows down or a sector faces challenges, your other property investments can help balance out your overall returns. Before committing capital to any platform, you must learn to analyze key commercial real estate financial metrics properly. One primary metric to evaluate is the capitalization rate, commonly referred to as the cap rate. This measures a property's net operating income relative to its purchase price. Another critical metric is the cash-on-cash return, which reveals the annual cash yield generated relative to the actual cash invested. You should also inspect the internal rate of return, which estimates the total compound annual yield over the entire holding period, accounting for time value. Familiarizing yourself with these standard financial metrics allows you to compare different platform offerings objectively and avoid low-yielding deals. Beyond basic metrics, evaluating the sponsor running the commercial property project is arguably the most critical step in your due diligence. The sponsor is the real estate firm responsible for acquiring, managing, renovating, and eventually selling the physical property. A highly experienced sponsor with a proven track record of navigating economic cycles is far more likely to deliver advertised returns. Inspect the sponsor's historical performance, total assets managed, and past deal exits before committing a single dollar. Remember that even an extraordinary commercial property can underperform if managed by an inexperienced or inefficient operating team. Understanding the fee structures associated with online crowdfunding platforms is equally vital for protecting your overall returns. Platforms and deal sponsors generate revenue through various fees, including asset management fees, acquisition fees, and performance-based profits. While reasonable fees are completely normal, excessive fees can quietly erode your long-term wealth. Always read the offering memorandum carefully to identify every fee associated with a deal before making an investment decision. Another crucial factor to consider when analyzing commercial real estate crowdfunding is asset liquidity, or the lack thereof. Commercial real estate is inherently an illiquid asset class, meaning you cannot quickly convert your shares into cash. Most crowdfunding offerings require holding periods ranging anywhere from 3 years to 7 years while the project plan executes. Investors should only deploy capital into crowdfunding platforms that they can comfortably leave untouched for the entire project lifecycle. Let us now compare commercial real estate crowdfunding with traditional real estate investment trusts, which are commonly known as REITs. Publicly traded REITs offer extreme liquidity because their shares trade on major stock exchanges every business day. Crowdfunding deals, by contrast, offer direct exposure to private property transactions, isolating your capital from stock market swings. Multifamily apartment complexes are generally considered resilient because housing remains an essential need regardless of economic conditions. Industrial real estate, including fulfillment centers and storage facilities, continues to experience high demand due to e-commerce expansion. Office buildings and retail centers can offer higher yields but require careful analysis regarding local leasing trends. Tax advantages represent one of the most powerful benefits of participating in equity-based real estate crowdfunding. Real estate depreciation allows you to offset a portion of your rental income distributions for tax purposes legally. Risk management must always remain your top priority when deploying capital into any online investment platform. To protect your principal, never allocate all your available funds into a single property, no matter how attractive the returns appear. Understanding the underwriting process used by reputable crowdfunding portals provides another layer of safety for prospective retail investors. Internal platform teams analyze property valuations, inspect financial projections, and conduct background checks on sponsors. A preferred return means passive investors receive a specified baseline return before the sponsor receives any profit splits. Minimum investment thresholds vary widely across different online platforms, making it easy to tailor a strategy to your budget. In a value-add project, the sponsor purchases an underperforming property, performs renovations, and increases rental rates. Ground-up development deals involve building new structures, requiring land acquisition, zoning permits, and major construction work. Stabilized income-producing assets present the lowest operational risk for conservative investors seeking steady cash flow. Monitoring your portfolio is straightforward thanks to modern online dashboards provided by platforms. Rising interest rates increase borrowing costs, which can impact overall valuations and net cash yields. Choosing well-capitalized platforms backed by reputable institutional venture firms provides added peace of mind for your digital investments. First, research and select top-rated crowdfunding platforms. Next, create your account, complete verification, and link your bank account. Finally, make your initial fractional investment, set up automated dividend tracking, and systematically reinvest your returns over time. Armed with this knowledge, you are now equipped to build a diversified property portfolio directly from your computer. Thanks for watching. Subscribe for more. Check out Real Estate Crowdfunding Platforms 2026 for a great visual breakdown.